First of all, from the economic reality, a lot of it has to do with what I have considered to be a poorly designed Fed buying program. I mean, if you think about it, the Fed boxed themselves in. They said they were going to buy a certain amount of treasuries, way too money relative to the amount being produced. And they said they were going to buy a certain amount of mortgages, again, way too many relative to the amount produced. So they limited themselves to having the capacity to do $300 billion of treasuries in the face of an enormous amount of treasury debt being issued. And on the other flip side, they said they were going to buy $1.25 trillion of mortgages in a market where you could not produce $1.25 trillion of mortgages. So you created this box, this situation where you had a huge imbalance between what was being produced and what the Fed was buying, and that created a material amount of problems. What they should have done is said, look, we're going to have $1.5 trillion of buying capacity, and we're going to use that buying capacity to stabilize markets. If treasuries get out of whack because there's supply and demand imbalances, we'll buy treasuries. If mortgage spreads blow out too much, we'll go and redeploy our capital to mortgages. So the lack of flexibility was one major contributor. The other thing is time. What we're realizing is, to heal the problems we have, we're not going to be able to do it in a short window of time. You're going to need a lot of time. And they limited their buying capacity to way too short a window of time. So if they had expanded and said, look, we have 2-3 years to use this, as opposed to we're going to keep buying every week regularly this amount of treasuries and that amount of mortgages, whether they're produced that week or not, that really contributes to some of the problems.